The market is finding the Brexit possibility increasingly hard to ignore and difficult to play. So how should investors trade Brexit? Brexit would almost certainly cause a big fall in sterling, possibly by as much as a third. The pound has dropped significantly this year as the referendum looms into view, and the price of hedging against Brexit's impact on sterling has soared. Expect a lot of pressure on sterling in the week of the referendum and a bounce in the pound if the vote is to remain, though over the rest of the year this bounce may be offset by weak economic data. If the vote is to leave, Brexit won't just hurt sterling. The euro and other European currencies will come under pressure as the impact of the EU could be significant. Instead, the US dollar, emerging market currencies, and maybe the Swiss franc look like being the currency trades to play. Brexit may well trigger economic downturn in the UK, and that makes bank stocks particularly vulnerable. That much is clear from looking at the widening spreads in banks' bonds. Profits of big commercial lenders could also be hurt, and expect securitization to be affected because of their dependence on EU regulation. So how to trade bank stocks? Go for stocks that do little trade in the UK, such as Standard Chartered, over those that are big players in the UK market. A vote to leave will be uncomfortable for the stocks of financial groups, retailers and construction companies. A lot of attention is on the consequences of Brexit for the City of London's international activities. But so far, investors aren't showing much concern. That could mean pent-up pressure being released on perhaps insurers if the Leave campaign wins out. Bear in mind that Brexit uncertainty has been holding back investment and consumption, so companies with exposure to the UK market will face further pressure if Brexit occurs. And if that does happen, the more internationally focused FTSE 100 companies will probably get a short-term lift from sterling's fall. Your preferred trades should be to stay away from the mid-cap FTSE 250 index, which is reliant on the UK economy, and to short financial stocks. A good Brexit trade might be to buy gilts. Why? Because Brexit would probably cause a shock to the UK economy, and that would prompt the Bank of England to keep interest rates low. So gilt prices should rise. But the gilt market is very UK focused. Brexit uncertainty has at times led to foreign investors selling more gilts than buying. And though they have returned to buying gilts, Brexit could result in those overseas investors abandoning gilts once again. There are signs of the referendum affecting British property. Commercial real estate stocks are under pressure as foreign buyers sit on their hands. So Brexit could have an immediate impact on the property market, particularly on construction groups exposed to London. Shares in Berkeley Group, a high-end house builder, have been hit as Brexit fears depress sales of £2 million plus homes. That's because of uncertainty about sterling. If you think Britain is going to vote to leave, stay away from the shares of developers building luxury homes. If, however, you think Britain is going to end up staying in the EU, now may be the time to make good on that London property you've had your eyes on.